Welcome to the Unsexy Businessmen podcast, where we talk about everything entrepreneurial and unsexy businesses. Today, as always, I'm with my brother, Alex Skinner. I am Aaron Skinner, and we have a special guest today, my CPA, Brian Basinger. And let's get into a little bit about Brian. Brian is a certified public accountant and tax strategist who helps entrepreneurs take control of their financial future. He's the founder of Entrepreneur Advisors, where he works with seven-figure business owners to stop overpaying taxes, save real money, and plan for strategic growth. What sets Brian apart is that he doesn't just file returns, he educates and empowers. He's passionate about helping business owners understand what they don't know, avoid the mistakes that cripple so many companies, and build lasting wealth through proactive planning. And I can say from personal experience, that is very true. And on top of that, he's a husband and a father who's been through the transition from comfortable payroll job to the unpredictable world of business ownership. Also, fun fact, Brian and I worked at the same call center. So that many of you have heard me bitch about for many episodes.
Also, Brian is the one who called it, how's your little carpet cleaning company doing?
Yeah.
So,
how's your little cleaning business going?
Did I say that?
No.
You
No.
didn't.
That was
Why would you guys bring him on?
I just wanted to say, I made it, Brian. Fuck you, man. All right, podcast over. No, that was a former manager of mine. Let's see.
Sorry for derailing you, Aaron.
Oh, no, you're fine. You're totally fine. So he really gets the entrepreneurial experience. Today, we're diving into common tax traps, mindset shifts that separate successful entrepreneurs from struggling ones, and actionable strategies you can use right now. Brian Basinger, welcome to the podcast.
Thank you very much, Aaron. You used transition and same sex in my intro, and
I could, right? He said same sex, right?
Okay.
Did I say same sex?
I don't know how.
Almost.
It was very close.
It was a tongue twister. It's a tongue twister. I couldn't memorize all of that. That's why I couldn't be an actor. Yeah, man. Yeah. So Brian, he's been my CPA for what, like 12 years, 13 years.
Yeah,
It's been a long time, a very, very long time. But yeah, dude, thank you so much for being on the podcast. This is going to be, I think, very informative and helpful for a lot of not even like new entrepreneurs, but entrepreneurs that have been doing it for a long time and maybe making a lot of mistakes. I'm going to get into the first question that I have is like, what is the number one tax mistake that's quietly bankrupting small businesses, in your opinion?
Ooh, I think I'll speak generally on it because I think in terms of like the details, it's really situationally dependent. But in general, it's not paying attention to entity structure, and having like the same dollar of income can be taxed more or less depending on what category of income it is and how it flows through entity structures. And entity structures will, like the right setup, will have the same dollar taxed or have less tax exposure, but also then sets up the ability to be more aggressive with things like deductions.
What do you mean by entity structure?
Well, that's where I mean different things at different levels. So
let's say it's someone who's just starting
Let's
off.
say it's me, Alex Skinner, circa, I don't know, 3 years ago. And I go, hey, Brian, I'm super scared that I'm not doing anything financially correct right now. And then you ask me, have you set up an S-Corp? Let's start there.
Yeah, that's where I was going to go.
That's
So
very specific, Alex.
For let's say under $500,000 in revenue businesses. So generally, newer businesses or even businesses that are getting their footing, it's initially not utilizing an S-Corp to help, one, just separate out the business taxes from your personal return, which can enable being more aggressive on deductions. And then two, to avoid or alleviate some of the self-employment tax. And then sort of the next step up from that is having an S-Corp, but not structuring it correctly as far as like balancing payroll and owner distribution, so that maybe you have the S-Corp, but you're not getting all the juice out of it that you could by setting payroll at the right amount and then taking more in profit.
So when, let's say we have a new entrepreneur just set up their LLC, should they immediately also set up an S-Corp?
No, I think what I always tell new entrepreneurs is set up an LLC. So if someone's just getting started,
Yeah.
you don't want the headache of the LLC, and you don't need it until you're making money. Usually, the threshold where you would want to move to an S corp, and just to clarify, that doesn't negate the LLC. The LLC is just like a container that legally holds the business activities. And then all we're doing with an S corp is just throwing like a label on the front of that container that says this is now going to be taxed as an S corp.
So sorry to cut you off. So let's
Yeah.
say they're starting off their business. They set up an LLC. At what point, and they're making $50,000 a month or whatever it is. At what point you're like, hey, you need to do an S corp? Is that after they're making $500,000 a
No,
year?
it's after about. So really, what matters the most is the profit number. And so if it's, say, I don't know, a more capital intensive business like a plumber or something, where they've got a whole bunch of expenses in the first few years, or a whole bunch of
Mhm.
equipment that has to be bought, they might
Yeah.
be doing well and having cash profits, but they've got all these bunch of equipment to write off. So
Mhm.
the threshold, to kind of get to the answer, is it's a profit threshold, not a revenue threshold. And if you think that the profit is going to be over, it's not that high, I'd say over like $30,000, that's where an S corp starts to make sense, because every dollar of profit that you have that's not shielded a little bit through an S corp is getting 15.3 cents of
Mhm.
it just in self-employment tax before we even start talking about income tax.
Right, which
So
is obviously a significant number.
that's
Right.
something I want to make sure I am clear on is, or also like for the listeners, when we're talking about LLC, we are talking about, like, let's just use Keystone as an example. So you still want to set up your Keystone LLC,
Mm-hmm.
have that going. But I think
Yep.
when we're talking about S Corp, we are talking more along the lines of your own personal LLC that's set up. Correct, or am I wrong there?
That actually is a really good point. So generally speaking, when I'm thinking about entrepreneurs, I'm thinking about like a single owner entrepreneur, someone who's setting up their own business. In that case, they've got this LLC that's the operating business. The whole objective is to just remove the whole objective initially is just to remove complexity and like bureaucracy. And so I say just form the LLC, because that gets the container established. And then we can make the tax selection on that container that makes sense down the road. What you're referring to, Alex, is when we have multiple partners, a lot of times it does not make sense to have that operating entity file as an S corp over the long run, because S corps are very strict with how they force the sort of splitting of profits according to ownership percentage. So that can just get tricky with multiple owners. It's like, one person might own a smaller percentage of the business, but they're working in it day to day, and the other partner might have funded it, but they're not working in it. And so the compensation needs to be different. And that's hard to do in partnerships, in S corps, in a way that doesn't cause extra taxation. So usually I think partnerships should be owned by, like, each owner should have their own LLC that is then going to file as an S corp. But for the single owner business, they can just use the LLC that already holds the business and just throw S corp, like an S corp election or label on the front of it.
Yeah. Once they hit
Gotcha.
that $30,000 profit threshold.
Yeah, exactly. Well, and that's the nice thing about the LLC is that, again, once it's there, the container's there. And so we can go back and even backdate an S corp election. We can get to the end of 2026 and say, like let's wait and see what the profit's going to be. Then we get to the end of 2026, realize, okay, we have, I don't know, 70,000 in profit. We definitely want an S-Corp. We can backdate an S-Corp election to the beginning of the year because that LLC was in place.
And
Which is
then
exactly what I had to
the
do.
actual process of setting up an S-Corp, is this something that would be easy enough for your common entrepreneur to do themselves? Or, I mean, obviously, I'm gonna say, do you recommend seeing a CPA? And there's gonna be some bias there, I'm sure. But like,
Yeah,
in all
well,
honesty, like, what's the difficulty for just your standard entrepreneur to go in and actually just set up their S-Corp?
it's not rocket science, honestly. It's if somebody, especially if a business owner is like an attention to detail person and doesn't mind getting in and doing a little bit of research, there's plenty out there, and it's just a form. It's a form 2553 that they have to fill out, and that's it. And the only tricky thing is if they're doing it late, there's like a very specific procedure. But if you just Google late S corp election, I'm positive there are going to be resources out there. So,
Well,
like, if you just don't want to mess with it and want to make sure it's done right, absolutely have a CPA do it. But it's not rocket science, and it shouldn't be something that costs much money at all.
what does that mean? Because I
Oh,
mean,
I mean,
we
like, if you're just getting a CPA to do it for you, I don't know. It's something that should be,
give us a number.
call it like $100 to $300 at the most.
Okay.
It's not
Well, that's
not a major
important
thing.
because we talk about that a lot on this podcast, and a lot of the videos that we make is how companies will just completely take advantage of like new entrepreneurs. And so like even with setting up an LLC, there's some out there that'll charge you, $500 to set up your LLC, and then they'll charge you, an annual fee to do your annual report at the end of the year, which literally takes, I don't know, 30 seconds to do. And so
Yeah.
it's that kind of stuff. That's why I wanted to kind of get a number. So if there is an entrepreneur, it's like, oh, I'll just Google, CPA that can help me set up my S corp, and it's like $2,000. They know that's a giant ripoff, as opposed to like, yeah, it shouldn't be more than like $300-400 to set something like that up. And but
Yep.
in all honesty, like if you have, this is my advice, if you have a business and you want it to function well, one of the main
Optimally.
aspects is making sure that your taxes and your payroll and everything is done correctly. Hire someone to do that. I did that from the very beginning. I've always had Brian take care of all my taxes, and just not having to worry and trying to figure stuff out was such a benefit for just like the amount of like mental energy that I had. So I could focus it on the actual building the business, while I had a professional that could take care of the taxes stuff that, if you're into that, you want to learn how to do that, great. But I'd say there's way more value in your time in building what you already know than trying to learn a very complex system that is constantly changing. That is our taxes in the United States, and probably everywhere, to be completely honest.
Yep.
Well, you should allow Brian or a CPA to like be your strategist.
Yeah.
I'm just going to voice what you're saying. We're like, you're going to give yourself time not having to think about tax strategy
Yes.
that will probably inevitably is. So yes, what Aaron said is true. You are going to be making more money because you're focused on the business, not on taxes. But then they are going to be making you even more money
Yes.
by because they already know that tax strategy. So it's like it's a win-win. And the mental anguish that you're talking about, I remember waking up, it had to have been last year sometime. Keystone starting to do well. I was just like, no, it was 2 years ago. Keystone was starting to like pick up a little bit. I'm just like, I don't want to go to jail for tax fraud or tax evasion or anything like that. It's just like, I wasn't expecting it to start making this amount of money. And I know that I'm going to get taxed on the profits. That's all I know. I need to just get rid of this burden. So I didn't even do it from like a tax strategy standpoint. I did it just purely from I don't want to
Peace of
even have to
mind.
think about this. I
Yeah.
know I'm not going to go to jail if I give this to somebody else.
Yeah.
At
Yeah.
least I hope not.
Brian will go to jail. I've told him that every time we have a meeting. I'm like, hey, buddy, you're going to jail if you don't do this right.
That's how it works, right?
But no, in all honesty, too, it's just like there's, even like to add on to what you said, Alex, there's been so many conversations that I've had with Brian where he's just like, hey, let's do this or let's do that. Like, this is the strategy. And it's, like I said, it's changing all the time. So there's like, hey, there's a new tax code that just came out that we can take advantage of. Let's do this. This is why. And then the thing I like about Brian is that you never just like, we should do this, and there's nothing else after that. He's like, this is why we should do this, and this is why. And he explains the whole thing. And so you should have a good relationship with your CPA where they are explaining things to you, even when sometimes Brian will start explaining things to me and my eyes glaze over, and I'll just at the very end, and Brian's probably experienced, but it's like, I always just like, how much money is this going to save me? Because it's like, it's really complicated for me, super easy for Brian. Just like I could get stains out of a carpet easily, and I could explain how to do that whole process, and Brian would be like, yeah, I'm just going to pay somebody to do it. It's nice because like you said, Alex, it's just saving you more and more money, because if you do it yourself, you're probably going to have some stuff that you missed because you're not the professional. They're the professional. So
Hey,
I
Brian,
agree.
can I ask you a question really fast?
Yeah.
I don't even think this is an accounting question, but if you were working with someone who was operating their business in their own state and they hired someone to be their registered agent, what would you tell them to not do that? Or would you be like, all right, or how would you go about talking to someone about that?
Again, it's sort of situational. To start
Right.
out with, I wouldn't bother with that. I think that's an extra expense that's unnecessary.
Brian's already saved you money.
Yeah.
Sorry, keep going. I apologize.
For a lot of, like, for business owners that are a little further along, and if they're concerned with an extra layer of privacy, then the registered agent can help with that. But honestly, in almost every state, with I think Wyoming being the main exception, the primary member, the managing member of the LLC has to be listed publicly regardless. So what I think makes sense is to have a business address, even if it's just like a UPS store box or whatever, just so that your home address is not listed publicly. And that is, if you don't have a place of business and you need a physical address, that's where, again, like, probably to start out with, these are not problems to worry about until you actually get the business going. But once you hit that point where you'd be concerned about liability from the business spilling over, that's when you might, assuming you don't already have like a public facing office or an address outside of the home, that's where it might be worth it to pay the $100 and have a registered agent.
And you're saying that's mostly for like privacy, right?
Yeah. It's that's all it is privacy.
Yeah.
You can list that registered agent's address, not your own.
Right.
And I just asked you that unprompted because that's like another thing that we talk about, like going back to like scams, like where people will have to pay $100+, sometimes it's in the thousands of dollars, like a registered agent fee on some of these other tools that we don't recommend. And so I asked you that unprompted, just be like, one, to say, see, we've been saying this accurately. And then two, like, just go sit, like, it all comes down to what we want people to do is not make the mistakes we did and save money. So I appreciate the response. And that's what I was hoping you'd say.
Yeah. Thank you. We would have cut it out if you did.
And like the added color that I have never thought of, where it's just like, and if you want some anonymity or privacy, I'm like, I've never thought of that.
Yeah. We always just say like, you have to have a registered, if you're doing business in another state where you're not at, it makes sense to have a registered agent. But other than that, it just seemed like a giant waste of money, unless you're want to be super private. But let's be real here. People could find out where you live. Like, we live in a day and age where no matter what you do, they could always find out where you live and all that kind of stuff. But I do agree that does help with privacy.
It's all just about hurdles. And I honestly, I wouldn't waste much time thinking about that stuff until, I mean, you're at least over $500,000 in revenue. Like, you just don't have enough customers even before then to like really worry about. You're not, nobody's even aware of you. So
and like, what business are you running where you're super scared of, people knowing where you're at? They have your phone number, whatever. Okay. Brian, people hate rich people. But what do, like, especially billionaires, they need to pay their fair share in taxes. What do rich business owners, and this could be an entire entire podcast. But just like, what are rich business owners doing with their taxes that normal business owners don't do? Like some key
Well,
strategies. And I'm not
yeah.
talking about like, well, they do the thing where they take a loan out against their stocks, like not
Yeah.
that, but like
Okay.
just
So we're not talking
more.
about billionaires. We're talking about,
Yes.
let's say like, millionaires and
Yeah.
just business owners who are
Yes.
doing well. It's, it starts, I guess, with a couple of things. First, it's planning proactively, which is just not done that often. Like most people are waiting until the year's over to send their stuff to their CPA and hoping to like get strategies at that point. But the real strategy is how things like taxes should just reflect what actually happened. And so the way that we most effectively change taxes is by changing what the circumstances actually are before the end of the year. So one is just getting proactive and just putting just a pro forma of the tax return down. If we don't change anything, what's the tax return going to look like? And then that kind of informs what things we might want to do. From there, there are, I would say, probably three general buckets. The first one that I already mentioned is entity structures, and that's huge because it kind of sets up the other two. And the other thing I'll note with entity structures is there's just past a certain point, there is like the tax code gets so punitive. It's not just the tax rate. It's that like deductions that you were eligible for start to phase out. You're not eligible for them anymore. And you get, yes, your normal tax rate goes up, but also you're subject to all these other little taxes that, an extra 3% here, an extra 4% there. And it just starts to stack up in a way to where it gets so punitive. And so what a lot of business owners will do is set up other entities. So something might be like a C corporation to where they can have profits that they control and have access to that are not on their personal tax return anymore. So like just using entity structures creatively again to kind of manage this. I, again, wouldn't even think about that until someone's clearing, at least over $500,000 in profit a year. But okay, and then the other ones are setting up deductions and taking advantage of tax incentives for investments. And so it's I want to invest in things, generally speaking, that I have some expertise in, that I can get a better than ordinary result because I know something about what I'm investing in, and that I can leverage, which could mean like financial leverage, like debt, but it also could mean that there are tax benefits associated with it. Like for example, real estate. It has there are tax advantages to it to where you can invest in real estate and effectively have like a government subsidy because of the tax benefits on that investment. And so I mentioned deductions and investments both broadly, but the idea is to make as much of your like big ticket spending items be able to be ordinary and necessary deductions into the business. And then your bigger investments aligned with the incentives that are in the tax code so that you can effectively get government subsidies on those investments.
Gotcha. And I realize this could be, again, a very complex and lengthy explanation. So thank you for making it as straightforward as possible. What are some of
Well, your
the,
eyes were starting to glaze over. So
I know,
but it's
like,
also like a good reminder of like why you hire somebody to do it. Like I
that's
think like because like with
yes.
Brian. So for example, we're gonna have people who are listening to this, and I guarantee are also gonna be like, but I think you going over like multiple things just reminds people why this is an entire industry and why this is like a business that you can
Yeah.
run.
Literally, while you were talking, Brian, I was like, and this is why I hired Brian.
Like we're deleting this episode. This is more.
No, it's good. Like it's just exactly
because people who do want to do it on their own are going to listen to this and be like, I should hire someone.
Yeah.
like it's going to be as simple as that. Like Aaron and I both did the exact same thing when I was starting to get nervous because we're moving from just like $20,000 into like $30,000 a month to $40,000 a month. I was just like, I know that this is something I have to get taken care of, and I'm busy growing my business. I don't have time for it. Just to reiterate what we said
Yep.
15 minutes ago, is this is the exact reason why people need people like Brian.
I
Right.
I can't tell you how many times I've seen the opposite, where I'll talk with an entrepreneur who is on the other side of this, who didn't, has not gotten any tax help. And like, it's almost always the same, like the same path. It's they start to make a little money, they get a tax return back from their CPA that they're just not expecting. It's all of a sudden like, you owe 50 grand this year. And I'm like, what?
Yeah.
I wasn't even,
Wasn't ready for that.
yeah, was like, had no concept that this was even in the possibilities. And then, they've got to like figure out how to deal with that. And then two, then they go the other way. They're like, next year they will avoid filing because they're like, I know it's going to be bad and I just don't want to mess with it or don't want to think about it. Or they'll like get over aggressive on deductions in some kind of obvious and not very like strategic ways and end up getting audited. And it's like these things they end up like derailing. You guys were talking about like the energy, and it takes a lot of energy to start and scale a business. And like,
Yeah.
it's just like these things
Both of
are
those examples were
holding
crimes.
headspace.
Yes. We call the first one the Wesley Snipes. The second one is, I don't know who the second one is, but that's all I was thinking of for the just don't file your taxes. Like doesn't turn out well for anyone.
And,
No.
Brian, I'd also ask, like, because I think last year was the first year I went through like the full, like, I started the year before, but last year was the first year I went through the S-Corp. Is it fairly common when people are doing it like their very first time, like that there's a learning curve to like, oh, I'm paying taxes every quarter now? Why am I
Mm-mm.
doing that? And why am I claiming I made way less money than I actually did?
So yes, but a good CPA should be kind of explaining those things and guiding you through it. But just generally on the S corp, the what I always tell people is, it's like before you have the S corp, you just have one hat. It just says self-employed. I'm self-employed. And then when you move to an S corp, you put that hat away and you get two hats, and one is employee and one is owner. And so you've got to take pay in both forms. And we want the pay as employee to be as low as we can reasonably justify, uh, because every additional dollar you take through W-2 wages, you're getting the payroll taxes siphoned off. Those are the same FICA taxes that we're trying to avoid with the S corp to begin with. So we want that to be as low as possible. And then, yeah, so you'll have, generally speaking, two ways that the company pays you on a regular basis. One will just be direct transfers, like profit distributions, and the other will be this payroll that gets set up. And you can run it quarterly, you can run it monthly. Generally, that's going to be a little bit more expensive, but like however you want to do it, you just have to set it up as low as possible and understand that, like, that's my employee hat that I have to get compensated for.
So what's the dumbest thing you see entrepreneurs spend money on?
Oh, it's cars for sure. But
Like,
I
how
say
can I
that,
make this
Can you- wait,
Lamborghini weigh
explain that.
4,500 pounds?
Like for the bit company or for themselves or both?
probably them.
oh, it's for themselves, but they'll run it through the business, and that's fine. You can run it through the business, and you can justify that. You can document the use, and like, there's nothing that's wrong with it other than the idea that, honestly, like, I like cars, and I think that's one of the perks of owning a business. So I'm not at all against buying cars, and understanding that there are tax benefits associated with them. I think it's important to get into a car. Uh, Maybe this is just my self-justification, but I think it's important to get into a car that doesn't like suck the life out of you.
Yeah.
And it changes kind of your mindset. And it's okay to also put a little pressure on yourself to be like, I just bought this expensive car. I got to go work. But just do it understanding that like it's an expense, and it's mostly uh yeah, it's a want, not a need, and the taxes are never going to like justify the car. If you're going to spend 100 grand on a car, maybe that's saving you 20 in taxes. great. But
You
you're
still
still
have to
spending
pay
80.
80,000. Yeah.
Yeah.
Yes.
Yeah.
Yes. So I think that's what you had told me, like when you're just like at one point you're like, you got to go buy a truck. And I was like, all right. He's like, but make sure, like, just realize exactly what you just said, like, but just realize it is gonna save you money, but it's make sure it's something you need. It's not just like, I'm gonna go buy a Ferrari and that was the other thing too. I think a lot of entrepreneurs don't know this, and it's something that I didn't understand either. You think like a write-off is like 1-to-1, and that's
Right.
not what it is at all. My entire life is like, awesome, I can just buy stuff and the government will just write it all off. And I'm just gonna be buying stuff constantly. But that's what like a good like rule of thumb is just like what you're saving 15 to 20% off of whatever you're trying to write off. Is that a good kind of number?
Yeah, it's probably 20. It depends. It depends kind of where your overall income is. But for someone who's making, let's say in the low to mid six figures, you're generally going to save something around 20% federally, and then whatever your state tax rate is. So 20, maybe 25% on the higher end.
So I think that is a very good lesson. Like if you buy $100,000 truck, it doesn't mean you get to take $100,000 off of your taxes. That's not
Right.
what it means. I thought that's what it meant when I first started my business. I thought so what write-offs were all about. That is not true. You're looking at like, just think of it as like, I get to save 20% on something that you should probably, something that you actually need anyway. Or if you're rich enough, you're like, it's nice to take 20% off. But there are also a lot of rules that go into that. I keep bringing up Ferrari, or whatever, because a lot of those things you have to be able to justify that it is a business expense. And there's a bunch of rules. If we're talking about vehicles, that they have to meet a certain threshold. And I think I'm pretty sure, especially with like when you and I were talking, it was like a certain amount of weight that it had to weigh in order
Yeah.
to buy it,
The rules have gotten
to
a
write
lot
it off.
simpler with the tax laws now. It used to be much more complicated, where it was like uh, the bed length of a truck had to be over 6 feet, and like
Mhm.
there were just all these, like, vans had very specific things about the windows that they had in them, and anyway, whatever. Now it's pretty much, because the deduction is based on bonus depreciation. Um, it's basically that it has to be over 6,000 pounds. And that's not to say that you don't get write-offs if it's under that, but you don't get that like upfront year one write off the whole thing. You've got to spread it over 5
Gotcha.
years.
Gotcha. Um, all right. So, what happens, Brian? I'm sure you've never seen this before, especially with like a new client. What happens when you grow fast, but your books are a mess?
Uh, you don't know
You
what's
piss
going
off your
on. Like,
CPA.
yeah, well, a couple things will happen. Either you like a lot of times you'll be less profitable than you should be, because especially when you're growing fast, it can be chaotic and it's hard to keep track of what money is going out where. And that's, I think, the biggest mindset shift for business owners, coming from being employees, at least it was for me, is understanding that like the scale of spending, like I was mentally tuned for personal spending scales, and it just feels like there's all this like big numbers coming in and going out, and you kind of get numb to it. And especially as you're growing fast, it can be really hard to track the spending. So it's important to just have good records so that you can look over them and say, what like,
Where's my money
yeah,
going?
yeah, where's this $50,000 a month going out? And okay, so that's one. And then two, on the tax side, just reiterating, anything that we're going to do from a tax perspective, well, 80% of what we can do from a tax perspective, it's got to be done during the year, like before we close out the year. And so if we don't have financial records to tell us what, like, to start off with that pro forma, what is your tax return going to look like if we don't do anything, then it's makes it near impossible to put the right strategies in place. And so then you just end up with like your tax return is like a gender reveal party where it's like,
Yeah.
what's the number? Yeah.
And I can vouch for Brian in this. We have
We had a
several
gender reveal
meetings.
party one year. No, I was kidding.
Yeah. We have several meetings throughout the year where we go over tax strategy, what I'm looking at as far as what I'm going to be paying in taxes. So the last thing you want is, which happens a lot, and I'm sure you've seen it a lot too, Brian, where at the end of the year, it's like, oh, by the way, you owe $100,000 and you haven't, your books are so effed up that you don't have savings set aside for any of that. Like, it just puts you in a
Yeah.
really bad spot if you're not proactively figuring all this out throughout the year, every year while you're running your business. Yeah, that is, again, hire a good CPA, hire a good CPA. Yeah.
With end of the year stuff, I know something that my CPA brings up a lot is like retirement planning and saving. What are your thoughts on that? And especially when it comes to like entrepreneurs, like how they should be going about using whatever opportunities there are for them.
I don't love qualified retirement accounts. I'm not like morally opposed to them, but I think that oftentimes they are like a reactionary attempt at tax planning. And to your point, Aaron, about like the misunderstanding of I'm going to buy $100,000 vehicle and that doesn't mean I'm saving 100 grand in tax. Same thing is true for retirement accounts. Like I'm going to put 30 grand into a retirement account. Yeah, it's an investment, not an expense. Okay, that's better. But that is only going to save you, let's call it 8 in taxes. And so from a cash perspective for a business owner, like the asset that you have expertise in, control over, and the ability to like lever either other people's time or other people's money to get an outsized return on your investment is your business. And retirement accounts are almost, it's like it's insignificant. I'm going to put money into a retirement account that's going to have fees sucked out of it all the time. Get pretty overall, I would say, like standard or substandard returns on that investment, or I could take that same money and put it back into my
Anywhere else.
business and help speed up that flywheel of like business growth to turn effectively like from nothing into $1 million plus asset. Like that's so for that reason, I don't love retirement accounts. And again, practically speaking, I just think they're used more often than not when the accountant hands over the tax bill and someone's like, what? What are you talking about? And they'll come back, well, we could throw some money into a retirement account. So anyway, that's my view.
So essentially, it's like invest. Sorry, Alex.
What you just said there at the end, Brian, like they come to you with like all right, you owe $50,000 on your taxes. Then the CPA says, well, let's throw some money into a retirement account to make it 42. Is that what you mean?
Exactly.
Okay.
But your total cash out, right? Cash that is no longer under your control
30,000
has gone
plus
up
8.
Because in order to get that tax bill down, you've had to lock money away.
In your example, it'd be 38,000 total.
Yeah. Let's see.
Well, sorry, I was doing the 50,000.
That would be the 50. So 42 plus the 30, so 72.
Oh, even worse. This is
right. So you go from 50 to 72 in cash, but you've saved tax, but you've lost access still to the cash that you put in the retirement account.
And so essentially what you're saying is invest in your business is gonna the outcome of that is going to be greater than anything you're going to see by putting it into some sort of retirement fund.
Yeah. Again, I'm not like an investment advisor. And so some of this is just my personal philosophy, but it's also based on a lot of observation and my own personal experience, which is I think anyone who's starting a business should have the very realistic goal to have that business either by selling it or by turning it into like a cash flowing model that they can rely on and eventually remove themselves from. Like that should be $1 million asset within 10 years and usually less. And so I would put all my chips into that basket. And then like if things are going great and you've got some extra cash and you want to diversify, phenomenal. But the retirement account is I just don't like the idea of like losing access to my money. I'd rather put it in my own brokerage account, pay the tax on it, put it in my own brokerage account, and be able to pull it out if I want to 2 years later to invest into something else.
Gotcha. Okay. Yeah, I get that. I get it. Do you have any other questions, Alex?
Yeah. How do you feel about Venezuela?
His wife's from Brazil.
From a tax perspective.
Just kidding. No, just kidding. Just kidding. No, that's all. I don't have any more questions. I just want to reiterate the same thing that we've been saying like over and over again. The fact maybe this is just me. The fact that I have learned stuff on this podcast by asking questions is just a really great reminder of why you talk with someone who knows about this stuff.
Exactly.
That's it.
Yes. Yes. Yeah. I can't even begin to imagine the amount of money I would have lost if I would have tried to figure all this stuff out on my own at all. Like it just, even like you might see like the fee for a CPA, whatever it is, monthly or annually, the amount of money that they're going to save you, is a good CPA is going to like dwarf whatever you're paying them. So that's the investment, right? Investing in people that know what they're doing and can save you money. Like, I know we should be doing a commercial for Brian.
I think you are.
Yeah, you're welcome.
It's the top 10.
All right. So Brian, we are going to get into the top 10 list. And so how this works, Brian, is you get 10 guesses. What do we do? Oh, you get 10 guesses. All right. So we have a top 10 list. The top 10 list is top 10 mistakes entrepreneurs make with their taxes, or
This
just
isn't your
just
opinion.
anything.
This isn't your opinion. This is based on.
The source is the AICPA and the IRS. So,
Oh no.
this is going to be, if you don't get these right, you're not going to have your license much longer. So yeah, and how this works too. So if you can't get at least 5 in your 10 guesses, then Brian is going to purchase one of our listeners our course, and the course costs $8 million. But Brian's been good with his money. That's nothing to Brian.
We just need to sell one course.
But if he is able to guess at least 5, then you will not get a free course. But if he does not, comment Brian sucks at guessing, and you can get a free course. I'm just joking, Brian. You don't have to pay for it, but you should. All right. So
only the first person to comment.
Yes. Yes.
All right. I will just take the L on this. I don't think I'm going to get many of them, but I'm going to give my own list.
I'm so far
okay.
2 for 2.
Yes. Yeah.
Alex, so I think you can do. Like, you just have to get 5.
Yeah.
Okay.
So top 10 mistakes new entrepreneurs make with taxes and finances and stuff like that.
Okay. I'm going to say, I'll even go with not setting up an LLC right away, not utilizing an S-Corp.
You're just going. Going. Okay.
Just wait. I got to go through.
Oh, you want me to stop?
Yeah.
Yeah,
After
You're going to like buzz me every time I'm wrong?
I have to. Oh, I'm going to buzz you. You want to know what? Yeah, your first one. So number 5 is choosing the wrong entity structure.
Okay.
So there we go. Good.
1. And then you said something about an S-Corp?
Or is that mixed into
Or is that
one?
together?
Yeah, I was kind of both in the same one.
Yeah, totally. It's the same answer. Okay. All right.
Let's go with not documenting deductions.
Oh God, I have to go through all these every time. So it's like, oh, you wonder what? Not keeping documentations for deductions is number 7, Brian.
Yeah.
Wow. Okay. So far, 2 for 2.
All right. Let's see. Other mistakes. Let's go with not filing extensions or not understanding the deadlines.
Extensions. Let's see. I might have to give you an L on that one.
All right.
I'm trying to think of this one. Yeah, I'm gonna say no. I'm gonna go with no on that.
Okay. If this is the AICPA, maybe they'll say going it alone or not getting a tax prepared by your CPA. Yeah.
I was always going to start reading out all of the
Yeah, read them
all of
for
the
me.
answers, but, all right, what does that say? Oh yeah, DIY bookkeeping with no review. I will accept that answer, Brian.
All right.
That's number 4.
Whew, okay.
2 more. You need 2 more.
2 more. Don't mess this up, Brian.
Let's go with not making estimated payments.
All right. I did see that. Where was that one at? That is one of them. Yeah, not setting aside money for taxes.
Right on.
That is
One
number
more.
2.
You're 4 for 5 right now.
Right, crushing it.
No,
I'm prove you're a great
I'm
CPA.
like channeling my inner IRS agent.
You're also just thinking of how all their stupid clients, former stupid clients, all your current clients are great.
not filing 1099s.
What do you mean by that?
What do I mean by that? So
My guess.
contractors, when a business pays contractors or employees, we could say payroll forms too, but like not.
Just not doing that. Okay,
Yeah.
I'm gonna give you that was close, but
man.
no.
I was feeling that one. I was confident there.
Wait, let me make sure, because I seriously have to read all these every single time.
After we just said you should hire a CPA to understand all this stuff, Aaron is judging what these actually mean.
I know CPA things. Yeah, no, that's I'm gonna. It was close, but I'm going to. It'll make sense when I do that.
review.
When I
Okay.
tell you why it's wrong.
4
more
go
guesses.
with being. I don't know. Let's go with being over aggressive on taking deductions, like deducting things that they shouldn't, that are not.
No,
it's not on there.
Crazy.
And think about and from like layman's terms, like what your common person kind of mistake that an entrepreneur who does not have a CPA would make. Or it says to help you out too is like when you're talking to somebody, you're like, I can't believe they're doing that. Okay, this is why you can't do that. You only need one more. Brian.
Let's say not filing taxes at all.
You
Is that on there? It happens
Yeah,
more than
that's
you
a
would
good
think,
one.
man.
That's a good one.
Nope, that's not on there.
Okay.
But that should
more
be, especially
guesses.
the IRS. That should have been like number 1.
Yeah.
Number 1, I'm surprised you haven't guessed number 1, to be completely honest, because it's a massive. It's definitely a mistake that I see entrepreneurs make all the time.
Is it just not getting like a tax ID number, like an EIN?
No. God damn it, Brian! You
No,
just
I'm
need
cold.
one more.
I'm like, yeah, I'm bricking all these.
I'm gonna read these all out to you. Be like, oh my god, oh yeah, because all of them are like make sense.
All right, I forfeit. I'll buy.
No,
the
you have
next
one more. You have
Oh,
one
I
more.
have one
You
more
got one more.
guess? All
You got
right,
one more.
All right, let's go. Okay.
And if you get it,
Let's
Suck
see.
it, audience.
Let's see.
it makes it more exciting if we never lose, though.
Yeah.
What are the most common mistakes? We talked about the S-Corps. We talked about.
So you got the not setting aside money. You have the
What's that?
DIY bookkeeping with no review, choosing the wrong entity structure, and not keeping documentations for deductions are the ones you have answered correctly.
Let's go with. Let's go with like commingling personal and business finance.
There we go, Brian. Number 1,
right.
Brian, not separating business and personal finances.
That was clutch.
Yes, that was clutch. That was the one that I think I see people do all the time. All right, so we'll go through the top 10. Number 1, not separating business and personal finances. Number 2, not setting aside money for taxes. Number 3, treating profit and cash flow like they are the same thing. Number 4, DIY bookkeeping with no review. Number 5, choosing the wrong entity structure. Number 6, mixing hobby and business activities, which kind of sounds like the number 1. Number 7 was, did I do number 7? Not keeping documentation for deductions. Number 9. So number 8, this is the one that I didn't give you, was paying everyone as a 1099 contractor to avoid payroll taxes.
Oh, interesting.
So that's why I didn't give you that one. So it makes sense why I didn't. Number 9 is ignoring sales tax, payroll tax, and other non-income taxes. And number 10 is thinking of tax planning only in April.
Oh, there we go. That
Okay.
makes
It's all the
sense.
stuff we talked about during
Makes
this during it. So good job. Whew. You saved yourself $8 million, which is nothing to Brian. But yeah, that's great. All right, now we're gonna get into listener questions. All right, here we go. The first one is, I run a home service business, mostly residential cleaning and small commercial contract. I started 4 years ago, and it was just me at first, but now I've got 5 employees and steady reoccurring clients. Last year, the business did about $750,000 in revenue. Good on
Great.
you. And after expenses, I cleared around $220,000. I'm still operating as a single member LLC, and my CPA basically just files my taxes once a year. Sounds like a great CPA. I keep hearing people talk. Hey, look at this. I keep hearing people talk about S-Corp's payroll and tax planning, and I'm starting to worry that I'm overpaying and exposed to something I don't understand. At this level of income, what should I actually be doing differently? Fire your CPA.
Yeah, that's pretty gross. I think, man, you're probably, I hate to say this, like salt in the wound, but you've probably been like overpaying by 50 to 80 grand every year. That's so, yeah. Get rid of that CPA. Find someone who will help put a plan together. But even for 2025, you can go back, because you have the LLC set up, you can go back and do a late S-Corp election and get the payroll. That employee hat piece is going to be tricky, but you can do it. Don't listen to anyone that's going to tell you can't. And if you need to, you can we're still in January, payroll reports are not final yet. You could squeeze in a payroll if you needed to for the first year. You could even give yourself a 1099 for that employee hat. Anyway, that S-Corp is the biggest thing that
Okay.
would change your whole world. And then from there, there's probably a whole bunch. If that's being missed, there's probably a whole bunch of conversations that should be had around deductions and just maximizing that and trying to pull that profit down. Take money that you're already spending anyway and see what we can classify as legitimate business expenses to pull that profit down.
Perfect. The bad news is, because we had to wait for this question, that was 2 years ago he wrote that. No, I'm just joking.
There's another 130 grand.
Minimum, right? Like, it's probably even more than that.
Yeah,
All right, next
probably.
question is, let's see. This year was the first time my business really took off. I run an online consulting company, and my income tripled, but I didn't change anything. I just kept pulling money out when I needed it and paying my normal monthly bills. Now it's January, and my CPA is telling me I might owe 6 figures in taxes. And I honestly don't have that sitting in cash because I reinvested it into ad software and hiring. What are people supposed to do in this situation? Did I mess up permanently, or is there a way to fix this when you get surprised with a big tax bill?
Well, the answer is probably the same. So one, don't file this theoretical tax return. If it exists as a draft, fine, leave it. Go get another opinion. You can. It's almost the same answer. One, I'll bet that a big part of that reason is that you're still set up as a single member LLC, a sole proprietor, and so if you have the LLC, a late S-Corp election would make all the sense in the world. And then if you've been reinvesting that into payroll and advertising and things like that, I wonder if there's like a tracking issue, because those should be expenses. And so a six-figure tax bill
That seemed way
means
high.
a whole lot of profit, right? So you probably have about 400,000, 400,000 at least in profit, may be the case. But I'll bet if you really go through that with a fine tooth comb, and again, have that same just like good, thorough review of where might you be spending money personally that we could justify it as an ordinary and necessary business expense. Let's pull, like, this would be a great time to pull in vehicles. This would be a great time to, like, we're looking for big ticket items to pull that business profit down as far as we can for tax purposes.
Man, gosh, the more you know. Um, I guess with like one last question for you. How often is it that you? So those are just two examples of what sounds like bad CPAs. How often
Yeah.
do you like onboard people who are like, oh my gosh, you've been uncared for, unattended to?
It's almost everyone that we onboard is like
Always.
that. And these are like real successful business owners who have sold businesses, who have, like it's kind of a disgusting amount of money that has been lost, but it's more common than you'd think, because most accountants are just like, that's how we're trained to do it. Like the engagement is the tax return. And so then it's like everybody's well-intentioned. Everybody's thinking, okay, what can I do to try and save money on the tax return? But it's just, all you're doing at that point is just reflecting what already happened, and there's not that much they can do. And then the clients will come and ask the question and say, what can I do to save taxes? But accountants are still thinking just in terms of the tax return. And they're
File
like,
the return.
yeah, you paid me for the return. I delivered the return. Now you want me to spend hours here in the middle of July to think about what you might be able to do. And they're just not set up to like charge that way. They're not set up to think that way. And like, so those questions, I say that out of personal experience, because that's how I started my firm. Is like, I would get those questions and it's like, geez, what come on, what do you want me to do with this? And it, eventually the light went on, and I was like, oh, that needs to be this, like, that's the engagement. And the tax return is just the
So then a very easy way for a person who's listening to this to be like, is my CPA good or not? It's, do they just file a tax return for you, or do they strategize?
Yeah.
Or, sorry,
Like what are you paying for? Because if you're only paying for a tax return and they're telling you that they're going to give you strategy because they know that's what you want to hear. And again, they're probably well-intentioned, but if you're not paying for tax strategy, then you're not getting tax strategy. You're getting
return.
The return that you're paying.
I mean, at that point, should you just use TurboTax? If like,
I think TurboTax is pretty good.
Yeah. Yeah. Yes.
It's just putting numbers in boxes, and I'm not opposed to people using TurboTax. The more important thing, if you could only pay for one thing, you could pay someone to do strategy for you, and then you figure out the tax return that reflects that strategy. You'd be way better off paying money just to have someone figure out, help you with strategy.
Right. All right. Well, thank you, Brian, for being on the podcast with us. I hope everyone learned a lot. I hope that you're all taking notes. And if not, just keep rewatching this video. We need the views. But if you have questions, submit those to unsexybusinessmen@gmail.com, or any comment on any of our posts or anything like that. But yeah, thanks, man. I appreciate you. Appreciate you coming out.
Yeah, it was a lot of fun. Thanks, guys.
Thank you for listening to the Unsexy Businessmen. Don't forget to like, subscribe, and leave a review. Now go get to work.